Gold was bumping up against $2,000 an ounce for like 3 years there. And then it finally blew through $2,000 an ounce, and then it blew through $3,000 an ounce, and then $4,000 an ounce without any real resistance. And you would think that big round numbers like 3,000 and 4,000 would just be stacked with people ready to sell.
Yeah.
But it wasn't the case. Gold just kept on going up. And so finally, people had enough profits to protect that they decided to take a little bit of money off the table. When gold was $4,100 an ounce, that means that going back 3,000 years, everybody who bought gold had a profit to protect. And so it's no surprise that a lot of people sold at that point.
Financial analyst John Rubino notes that gold's recent rally marks a defining phase in a long-term bull market. After consolidating around $2,000 for years, it broke decisively above $3,000 and later $4,000 per ounce, signaling renewed distrust in fiat currencies and rising global demand for stability. This sustained surge reflects investors' growing preference for tangible value amid fiscal uncertainty and currency weakness. Rubino explains that when gold touched $4,100, nearly every investor in history held profits, an extraordinary moment that prompted natural profit-taking. Funds like Miller's Strategy Shares Gold Enhanced Yield ETF, offering gold exposure with a 5% yield, have further expanded participation and reinforced gold's reputation as a dependable, income-backed refuge. According to Rubino, the market's current pullback is a healthy correction within an ongoing uptrend. With inflation and sovereign debt still escalating, gold remains the world's most trusted hedge against financial instability. Before we dive deeper into this discussion, make sure to subscribe to the channel and hit the notification bell so you never miss an update on the latest market insights and trends.
Yeah, the gold and silver story is very simple. Those are the old kinds of money that have held their value for 3,000 years. And that's where we hide out when we don't trust the currency managers of whatever money the country's government is using right now. So we pile back into gold and silver when we're afraid of inflation or debasement. And that's why gold and silver are going up right now, because we're afraid of what's happening to the world's big currencies. So that's super simple, easy to understand. And that we had a big correction right now is completely natural because gold and then silver had huge runs. Gold was bumping up against $2,000 an ounce for like 3 years there. And then it finally blew through $2,000 an ounce, and then it blew through $3,000 an ounce, and then $4,000 an ounce without any real resistance. And you would think that big round numbers like 3,000 and 4,000 would just be stacked with people ready to sell.
Yeah.
But it wasn't the case. Gold just kept on going up. And so finally, people had enough profits to protect that they decided to take a little bit of money off the table. When gold was $4,100 an ounce, that means that going back 3,000 years, everybody who bought gold had a profit to protect. And so it's no surprise that a lot of people sold at that point. And it's also no surprise that some governments decided to jump into precious metals and try to manipulate those monies down a little bit, because when they go up like that aggressively, it makes the big currencies look bad. So you had people who had bought along the way up selling, and you had governments manipulating the market via futures contracts and stuff like that. And so you had a reasonable correction, completely to be expected, not scary in any way. And something where, as long as you're in a bull market, buying the dip is what you should be doing. And it's been that way with equities for a really long time. The people who bought all the corrections and all the bear markets ended up making money in the end. And I think it's the same way with precious metals now. We've got a long bull market here. As long as governments are overspending and overborrowing, and in that way debasing their currencies, then capital will flow into gold and silver because that's where you hide out in that kind of a situation. So, yeah, the correction that we're having now is normal, natural, and healthy, and we should treat it as a buying opportunity. Although I don't know where it ends. I don't know what the bottom of this correction is. Maybe we're already there. Maybe gold has to drop a lot further. But either way, it'll make gold related things cheaper. And let's say you're buying gold mining stocks, that gives you a chance to put in some lowball bids just to see. You might get a chance to buy Agnico Eagle for $20 lower than today or something like that. And in the long run, that's a very good thing. So don't don't be spooked by this, because corrections in bear markets, basically that is their function. It's to shake weak hands out of the market and put the asset into strong hands who have no intention of selling at the current price. And that process is going on now in precious metals and to an extent the mining stocks. So don't let yourself be shaken out. It's reasonable to be the one taking some profit after a nice long run like this, but don't be spooked completely out of this market, because until we have the currency reset, the bull market for gold and silver is not over. So you want to stay with it while it's in its, let's say it's in the third or fourth inning of a long baseball game right now. There's no reason to get out now. Taking a little bit of profits here and there, that's fine, but don't bail completely and then move on to something else. This should still be a core holding for people whose main focus is the giant financial crisis that's coming our way. Yeah, well, generalist money usually flows into the big names in the space first, because that's what they recognize, and that's what a financial planner, if you go to them and say, buy me a gold stock, well, they'll buy you, Newmont or Agnico Eagle,
Yep.
and maybe Barrick or something like that. And then as you're successful with those first few purchases, you start looking at what else is down there that might go up even more. And then you get a serious broad-based bull market going. And we're in that phase now where, lots of people bought the big miners and bought the big ETFs that own the big miners. And now they're looking around for something with a little bit more action, because they're cocky. They made some serious money. They think they know what they're doing in this space, and so they're going to start taking bigger chances with less well-known names. And usually in precious metals bull markets, you get like a year or two towards the end where the really crappy names are the best performers, because they're very thinly traded, they're illiquid, and generalist money is buying them because they have gold or silver in their name. We're not there yet, but that is something that's probably coming the way this is going. The big miners buy out the high quality smaller ones, and then generalist money starts pouring in to ride that acquisition wave by buying just basically anything in the space. So that's not a reason to go out and buy crappy names. You always want to stay with quality, but it's just an amusing thing that happens towards the end of the cycle, and we're a ways away from that, but not that far. Let Newmont go out and make some big acquisitions, and that should do it.
According to John Rubino, gold and silver remain timeless stores of value, trusted for thousands of years, whenever faith in fiat currencies fades. He views the recent pullback in gold after its rapid rise past $2,000, $3,000, and $4,000 per ounce as a normal, healthy correction rather than a cause for concern. Investors are simply securing profits, while governments may be subtly intervening to maintain currency credibility. Rubino believes this moment should be treated as a buying opportunity within a broader, long-term bull market driven by debt expansion and fiscal instability. John Rubino explains that market corrections help strengthen the foundation of long rallies by transferring assets to stronger hands. He advises investors to hold core positions as the metals bull cycle remains early. Over time, capital will likely expand from established miners like Newmont and Agnico Eagle towards smaller, undervalued opportunities.
Yes, exactly. It's got to be a legit copper mine, or where the government in the Latin American country where the mine isn't going to just come in and close the thing down like with Cobre Panama. So there is There's a lot of risk associated with mining in general. And, the copper space is no exception. But if you've got one of the good ones, one of the mines in a jurisdiction where they're going to leave you alone and or take care of you, and you've got a really long life, low cost mine, then it's going to be really valuable. Or it is really valuable today, but it's going to be much, much more valuable going forward because there just isn't that much of such things out there. We've spent 2,000 years looking for copper deposits, and we found the easy ones. So there are still some more out there, but they're, for whatever reason, not easy. They're in a tough place, or the grade is low, and or there's some other metallurgical thing going on, and it's just it's tougher to mine now than it used to be. And part of that, the reason for that, is that we found the easy deposits. So now we're having to work a lot harder to get what used to be fairly easy to do. So if you've got one of the easy ones, if you've got a high quality mine in this space, you're going to tend to make a lot of money going forward. So that's part of the commodity complex thesis, is that the copper story is kind of replicated by a lot of other commodity stories out there where, okay, we're going to need this stuff, but there just isn't that much of it that's easily accessible. So we're going to pay way up to guarantee our supply. Mm-hmm. And so you want to be in the names that fall under the heading of guaranteed supply, and commodities have gone up a little bit lately, but compared to, for instance, the S&P 500, you compare the S&P 500 to the commodities index, it's no comparison. The stock market is much more expensive than commodities are right now. So commodities have a long way to run in general over the next decade or two. And you just got to make sure that you're in the right names if you're buying stocks. But another way to do this too is the fiscal ETFs, because now there's a fiscal ETF for most of the commodities out there, most of the really big commodities. You got one for uranium, you got a couple for silver, obviously for gold. There's one for copper that just got created by Sprott lately. And that's a place to start if you're building a commodities portfolio. You buy the fiscal ETFs as a way to participate in the increase in prices of those commodities without the mining risk. And then from there, you can go and look at the mining sector in a given commodity and see what the highest quality names are. And then from there, you work your way down as you learn more to less well-known names, and then you try to separate the wheat from the chaff, and get yourself some equity positions that can be potentially 10 baggers. And that's the culmination of the process. You get a few 10 baggers towards the end, and then your wealth goes up exponentially, and you are officially a successful investor, and that's the kind of thing that happens towards the end with that last move into the 10 bagger space. And once you've experienced a couple of 10 baggers, it's very addictive. I think it ranks right up there with heroin or something for most people once they've experienced it. Well, yeah, the physical ETFs, you have to separate gold and silver from the rest of them, because with gold and silver, you can actually buy physical metal and store it yourself. So, but you can't do that with copper, obviously, because it's really cheap per pound. You would have to, you'd need, an entire barn-size outbuilding and a whole bunch of earth-moving equipment to move it in there. But and you can't do that with uranium because it's radioactive. So with those things, the closest you can get to physical is a physical ETF.
Yeah.
With gold and silver, obviously, you want to start with it in hand, in part because it's so cool to have that much silver. If you have a decent amount of silver, you've got this pile of gorgeous coins. See, I'm betraying my obsession now. I'm kind of a miser when it comes to this stuff. Was it Donald Duck, who had an uncle who was a miser, and he'd stack his stuff on the table and everything, and look at it and fondle it. I kind of do that with silver coins and sometimes with gold coins. So that's one of the that's one of the advantages, besides having total control over it, of owning physical metal yourself, because you get to decide where it's stored and you get to access it when you really need to. And you can't do that with copper under any circumstances, and certainly not uranium. So those are different things. But that doesn't mean gold and silver physical ETFs aren't a good thing to own. It means it's just the second step in the process instead of the first step. So with gold and silver, you buy the physical, have it delivered to you, and then you buy an ETF, a physical ETF, and then you buy high quality mining stocks and so on. But yeah, there's basically a lifetime worth of steps for a gold bug to go through before they get to the end of the process where they're buying 15 cent a share explorers from Tanzania or someplace.
The copper and broader commodities story highlights a critical imbalance between rising global demand and limited high-quality supply. With most easy copper deposits already discovered, miners now face greater technical and geopolitical challenges in extracting new resources. This makes existing low-cost, long-life mines particularly valuable for the future. Investors are increasingly drawn toward commodities as stock markets remain overpriced, and physical ETFs offer a safer entry point without direct mining risks. But how does one truly balance security with long-term growth potential? A wise strategy begins with physical holdings in precious metals, like gold and silver, followed by ETFs and selective exposure to strong mining equities. Over time, as experience grows, investors can explore smaller, higher-risk ventures, those rare 10-baggers that define lasting wealth in the commodities cycle. If you found this useful, hit like, share your thoughts below, and subscribe with the bell on for more quick market insights.